Business succession planning tips: how to prepare for your company's future. As a long term business owner, you've probably invested a lot of time, energy, and money all those years in order to grow your company. If you now want to move on from the business you've built, either because you're nearing retirement or no longer have the passion to keep pushing, you should take a few steps to make sure the company continues to thrive. Watch this video to understand how succession planning and, to a certain extent, estate planning ensures your business will be built to last. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing marvelous. If you're doing as great as I am, go grab a cup of coffee. What? And let's roll. Today I want to talk to you about business succession planning tips. How do you need to prepare for your company's future? The first thing you want to do is, let me just explain to you, and you need to understand what a succession plan is. A succession plan outlines what will happen when the owner of a business decides to leave their leadership role, right? This is basically a roadmap that allows the business to navigate this change and how the assets of the company will be treated in the process. Now, think of it as a plan for transitioning management. Either by selling the business, you can pass it on to your heirs, or turning over to employees, right? A succession plan can encompass a lot of things, and it can have the value of the business, the future segregation of responsibilities, agreements that you've had between the partners and heirs, and any other factors that can affect the company's future, right? The good thing here is that succession plan gives a clear idea. It just puts everybody on the same page when it comes to the transition, when it comes to the after the new leadership route, if you will. Now, what are the benefits of succession planning? If you do it right, if you have an effective succession plan, you, the owner, are able to have a voice in the future of your business while you're still alert, right? Let's say, the older you get, chances are, God forbid, something happens and you're not intellectually capable anymore, you're not emotionally or physically capable. You, right now, while you're still alert, you have a voice. You can have a voice in the future of your business. It helps ensure that the business will operate smoothly, that the inappropriate people will inherit the company, and if you're selling a company, then you get a fair deal, right? Having a plan also helps you minimize things like estate taxes and expenses, right? While maximizing the wealth passed on to the next generation. Now, if you are able to appoint someone to fill that role, isn't that wonderful? Because it provides stability for the company, employees, customers, and family members, particularly if the transition is the result of an unexpected event, right? Now, remember though that a succession plan is very critical, particularly for a family-owned business. Now, I'm not saying that if you are a business owner, you have to wait until you get old to come up with a succession plan. You can still do it while you're young. It depends on your priorities and objectives. If you want to see the ownership of the business while you're still healthy and young in your 30s or 40s, go for it, right? Now, remember though that you need to decide very clearly whether you want a spouse or a child to take over the business, or whether you want children to take over the business. That has to be clearly stated in the succession plan. Now, let's talk about the timing of succession planning. Now, when should you, as a business owner, outline a succession plan? Now, I think, and this is based on research that our team, the Sweetie Kiwi Show team, has done over several years, you want to think about succession planning from day one. Even in the early stages, you want to have a vision for the aftermath, right? Because that allows you to protect your business. because planning early may help you in the long run because it gives you really time to improve the business so that when you choose to sell the business, you can get the best price. All right. So I've explained to you what a succession plan is, the benefits of succession planning, and the timing of succession planning. Now, let's talk about the specifics of the planning process. I'll do this right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing marvelous. If you like the content clarity and quality so far, please consider subscribing to our channel. Turn on the notification bell. Comment below. Share this experience. Share this content with others, and like it. Now, what are the subtleties of the planning process? What are the specifics of the planning process? Now, first thing you want to do is you want to establish the goals. What are your goals? Are you trying to get control of the company? Do you want to maintain management over the company in the process? What kind of activities do you want to protect? Right? You want to think about why you want to cede ownership of the business to somebody else. Think about the current value of the company. How do you want to value the company? Is it based on assets and liabilities? Is it based on the potential in the industry you're in? Right? Another specifics you want to think about is, does it make sense to continue operating the same way, or should responsibilities be shifted? Another question that is important is, does it make sense to allocate leadership roles to the same people, or should responsibilities and leadership roles be shifted? Another thing you want to think about is the skills, the qualities, the capabilities of an appropriate successor will be, right? Do you want somebody from the family? Do you want someone from another family, or just an expert in the industry? Those are questions that are part of the planning process that will help you identify whether or not you're ready to engage in a planning process in the first place. Now, let's talk about another important element here. What are the fiscal implications of succession planning? A lot of small business owners think about if they ever do succession planning without looking at the fiscal aspect of things. Now, are there potential tax implications to consider? Of course, yes. Whatever the future plans are for your business, every succession plan must comply with the IRS tax code. Right? So you want to first get a good business valuation, because this will give you an idea of how the IRS values your company. From there, you can start determining the potential tax liability of selling or transferring ownership of your business. Now, at this stage, I always emphasize that you want to reach out to a professional, right? You can reach out to a CPA, a certified public accountant, or you can reach out to an EA, which is an enrolled agent. Those two categories of professionals are, they have received the blessings of the IRS. They have passed very stringent exams and very stringent CPE, continuing professional education criteria, to be able to be where they currently are. So you want to reach out to one of those, and it will help you understand the exemptions, exclusions, and deductions that may affect the financial impact of the business transition. Right? So you also want to reach out to a small business administration expert if you have the budget for it, so you see again the fiscal implications of such a transfer. Now, whether you're just getting your business off the ground or you're looking to retire, having a succession plan in place is important for small businesses, because they can help your business move through changes and increase the likelihood that your business will continue to succeed for years to come without running afoul of tax laws. Okay, so this is very important. Think about the specifics of the planning process and the tax implications of succession planning. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having a conversation here today about how to prepare for your company's future when it comes to business succession planning. If you like the content's clarity and quality so far, please like this content, share it, comment below, and most importantly, subscribe if you haven't already done so, and turn on the notification bell. Now, let's talk about succession planning and estate planning. A lot of folks confuse those two terms, right? Now, succession planning directly relates to the actual business itself. Let me repeat that. Succession planning directly relates to the actual business itself. Estate planning, on the other end, relates to all the assets in an individual estate, including any ownership interest in closely held businesses, right? So now the lines kind of blur when a family business comes into play, right? Because for a lot of business owners, estate planning and succession planning go hand in hand. If you think about it, right? Because if you are, let's say you own a closely held business, you'll have a significant portion of your wealth tied up in the business. So if you don't take the proper estate planning steps to ensure that the business lives on after you're gone, you may be placing your family and future generations at risk. So one thing you want to think about doing is, again, we're not here giving you advice about how to run your business. We're just providing the results of our research. Obviously, you want to get an expert to verify and bless all decisions that you're making. But one thing you want to do is to separate ownership and management succession, right? Because when you transfer a family business, there could be a challenge, because you got to have a distinction between ownership and management succession. When a business is sold to a third party, the management succession and the ownership typically occur simultaneously, right? But if you have a family business, there may be reasons to separate the two. Let's say, for instance, if you have an estate planning overview here, when you transfer assets to the younger generation, if you do so as early as possible, you're able to remove future appreciation from your estate, thereby minimizing estate taxes. On the other hand, though, you will not be ready to hand over the reins of your business, or you may feel that your children aren't yet ready to take over, right? Because you got to be right. You have to be lucky that your children are competent, they are passionate, and they're willing to take over. Now, when it comes to that, experts have several strategies that business owners can use to transfer ownership without immediately giving up control. So one is you can place the business interest in a trust family limited partnership. In other words, that's what they call FLP, or another vehicle that allows you, the owner, to transfer substantial ownership interest to the younger generation while retaining management control. That's the first option. You can also transfer ownership to the next generation in the form of non-voting equity, non-voting stock. Second option, or third option, you can establish an employee stock ownership plan, an ESOP rather. So, those are the three things. Those are the three ways. So you can place the business interest in a trust, family limited partnership, or other vehicle. You can transfer ownership to the next generation in the form of non-voting stock, or you can establish an employee stock ownership plan. Now, another reasons why you need to separate ownership and management succession is that you want to deal with family members who aren't involved in the business. If you have a large family and some of them are passive partners, they're silent partners, they're not interested in the business, they just want to get the money and get their equity going up, you want to be able to have a separate ownership and management succession planning process. You can also do so to provide heirs outside the business with non-voting stock or other equity interests that don't confer control of the business. Remember, it's all about having control, right? So you can transfer the equity, everything is fine. They're making money, they're getting dividends from the business, but they don't have control over it. And another thing you want to think about is to work around conflicts. Now, there is a unique challenge that family businesses have is that the older and younger generations may have conflicting financial needs. Not right. So you're able to use a number of strategies to manage to tamp down on those conflicts, right? You can do something called an installment sale of the business to children or other family members. This is great because it provides liquidity for the owners while easing the burden on the younger generation. And most important, improving the chances that the purchase can be funded by cash flows from the business. You can also use something called a grantor retained annuity trust, a GRAT. So by transferring business interest to a GRAT, you, the owner, obtain of various gifts and estate tax benefits, provided your beneficiaries survive the trust term, right? So while enjoying a fixed income stream for a period of years. Now, what happens in a GRAT scheme is that at the end of the term, the business basically is transferred to the owner's children or other beneficiaries. Now, remember that the beauty of this is that GRATs are typically designed to be kept tax-free. Another way to work around conflicts, and again, the conflict here is that the older generation and the younger one may have different views, different visions, different business models in mind. So you have something called an installment sale to an intentionally defective grantor trust, an IDGT. So you sell the business by installments to an intentionally defective grantor trust. Now, this we're going to have a whole show about it because it is very complex transaction. But in a nutshell, a properly structured IDGT allows an owner to sell the business on a tax-advantaged basis while enjoying an income stream and retaining control during the trust term. Right? So once the installment payments are complete, the business passes to the owner's beneficiary free of gift taxes. All right? So this is basically it, folks. We just want to quickly wrap up today's conversation here. And so the business succession planning tips, how to prepare for your company's future. I spoke about 6 things. I defined what a succession plan is. I gave you the benefits of succession planning. Timing of succession planning was another topic I spoke about. The specifics of the planning process, the tax implications of succession planning, the succession planning and estate planning, sort of like give you the compare and contrast version of the two. Now, here is a pro tip before I actually leave today's conversation off. Each family business is different, so it is important to work with your estate planning advisor, your CPA, your EA, or any estate lawyer to identify proper strategies in line with your goals and resources, right? And you want to start as early as possible. Why? Because the earlier you start planning, the better. So when you transition your business gradually over several years or even a decade, you are able to educate your family about your succession planning philosophy. That creates fewer conflicts, right? It allows you to also relinquish control over time and to implement tax-efficient business structures and transfer strategies. Thank you so much for listening to me today in today's conversation. I will see you next time. And until then, remember, stay marvelous.